A nice time we meet again, guys, for a session of financial reporting and analysis. So we are going to do a continuation of our Zoom classes, the online classes, of which we have done some other areas from our previous sessions. Like now, the class which was yesterday, we did International Accounting Standards 41, which is all about how you are supposed to account for the agriculture and farming activities, of which I gave out an assignment. I think some of you have done the assignment. So you need to confirm the answers. So if you have done the assignment, you can request for the solution. But at the same time, that question is done. It's recorded. I think you have the recordings. So you can go under my recordings, under the agriculture and farming activities, the one I shared to the WhatsApp group. You can go and watch maybe where you made a mistake. The same question I gave out yesterday for that. It was a question of 2020, November, question 5. So for today, we are going to talk about accounting for income taxes, accounting for the income taxes. So when you account for the income taxes, remember that you have to talk about the current tax and you have to talk about the deferred tax. So you need to know how you are supposed to account for the current tax and the deferred tax. So that is what we are going to do. And we do some 2 or 3 illustrations on the same. Then we can say that we are done. And this topic will be of assistance to us when we will be doing IPSA, that is IS1, which is all about the preparation of published financial statements. So it will assist us when we will be doing the IS1. So the topic of today is all about accounting, how you are supposed to account for the income taxes. So under these income taxes, to summarize, before we go through the notes, what you need to know is all about on how you are supposed to do for the current tax and on how you are supposed to do for the deferred taxes. On how you are supposed to do for the deferred taxes. So when we talk about the current tax, these are just the tax which are applicable to a company, the tax which the company is supposed to pay. It's like now an obligation to the entity in the current year under consideration. So if it's in the year 2021, the tax which the company was supposed to pay in that year, how would the company know that this is the tax it's supposed to pay in that period? So we say that it's all about taxable profit times the tax rate. We talk about the taxable profit times the tax rate, of which you need to know how to compute for the taxable profit. Taxable profit is equal to accounting profit before tax, accounting profit before tax. So the accounting profit before tax, you add the disallowable expenses, you raise the allowables, you minus the allowable expenses. So which are some of the disallowable expenses? These are like things like impairment, we have depreciations. So allowable expenses, we have now the normal business expenses, the one which reduces your taxable income. But the disallowable expenses, they are not supposed to reduce your taxable income. So that is why they are always added back to the profit. So they are not considered. The disallowable expenses are the expenses which are not considered to be used in the generation of business income. That is what you need to know on how to get the taxable profit. So once you have your taxable profit, then you multiply with the tax rate. Once you have your taxable profit, then you multiply with the tax rate. Remember the tax rate you will be told 30%. That's all. Then another thing now here is all about how to arrive at the deferred taxes. Deferred taxes is all about future tax obligations. So you make provisions for the future taxes. It's all about the provision for future taxes. Provision for future taxes. So that is all about the deferred tax. So how do you get the deferred tax? We have 2 methods to use, but one is the method which is recommended. So we have the income statement liability method, income statement liability method, income statement liability method, income statement liability method, and we have the balance sheet liability method. We have the balance sheet liability method. We have the balance sheet liability method. So according to the relevant standard here, the method which is recommended is the second one. The method which is recommended is the second one, the balance sheet liability method. The balance sheet liability method is the one which is recommended. Balance sheet liability method is the one which is recommended in the determination of the deferred tax. Why it is recommended unlike income statement liability method? So for the balance sheet, from even the balance sheet itself, it has items which shows the financial position of an entity. The items which doesn't fluctuate from time to time. So it has items, the items to be used are the ones which shows the financial position of an entity, which doesn't fluctuate from time to time. Unlike the income statement liability method, which contains incomes and expenses, which fluctuate from time to time. That is the justification why the balance sheet liability method is recommended, unlike the income statement liability method. Then, now, since the balance sheet liability method is the one which is used, we always say that it views deferred taxes, it views deferred tax, it views the deferred tax to arise from temporary difference, to arise from temporary difference, to arise from the temporary differences. So this one views deferred tax to arise from temporary difference. That is why we go ahead and say that. Now, how do you arrive at the deferred tax? So the deferred taxes will be the temporary difference, will be temporary differences times the tax rate, times the tax rate. How do you get the temporary difference? How are you supposed to get the temporary difference? You say carrying amount minus the tax base. Carrying amount, you minus the tax base. You minus the tax base. Where the carrying amount will be, carrying amount is equals to what? The cost minus accumulated depreciation. Accumulated depreciation. Tax base is equals to the cost minus accumulated capital allowance, minus the accumulated capital allowance. So the carrying amount can be called net book value, NBV. The net book value, the tax base can be called the written down value, WDV. So the carrying amount, you can call it the net book value, or the tax base, you can call it the written down value. So we have types of temporary differences. We have types of temporary differences, which is a taxable temporary difference. So types of temporary difference which can be given. So types of temporary differences. So the types of temporary differences are two. So the first one being the taxable temporary difference, and the second one being the deductible temporary difference. So number one, we have the taxable temporary difference. We have the taxable temporary differences. And number two, we have the deductible. We have the deductible temporary difference. We have the deductible temporary differences. So when we talk about the taxable temporary difference, is whereby the carrying amount is greater than the tax base. Is where the carrying amount is greater than the tax base. For the deductible, is whereby now the carrying amount is less than the tax base. For the deductible, is whereby the carrying amount is less than the tax base. Is less than the tax base. Once you know that, there's nothing you can't do There's nothing you cannot do under that deferred taxes. Under the deferred taxes. So there's nothing you can't do. So the deferred tax is the one which might be in need of maybe a lot of workings, because the current tax you have realized that it's just simple. So the deferred tax or the accounting for income tax, generally, the information I've explained, it's according to International Accounting Standards 12. So if you want to do more research of the same, you just go to the Internet of Things. So, and just Google IS 12, International Accounting Standards 12. We have that page of International Accounting Standards Bond. And you can read more from there if you want more information about International Accounting Standards 12. But what I've mentioned for the CASNEB exams, that is what you need to know before we do the questions. That is what you need to know before we do the questions. But now, before I go to the questions, I can go through these notes of ours a bit very fast, because already I've simplified what you were supposed to know. So they say that income taxes are a tax payable during or after the financial period under consideration. So when calculating for income taxes, they normally arise a difference between taxable profit and accounting profit. So when you are computing for this aspect of income taxes, they may arise a difference between the taxable profit or accounting profit. You know, there's a taxman and there's an accountant in this world of accounting and tax. So what brings this difference? So it's all about permanent differences and temporary differences. Permanent differences and temporary difference. So when we talk about permanent difference, is whereby you find that an item has been considered in one profit computation, but ignored in the other. When I say that an item has been considered in one profit computation and ignored in the other, I mean that an item has been considered, let's say, in accounting profit computation, but ignored for tax purposes. Like now, the aspect of depreciation and director's entertainment, they are treated as normal expenses in accounting purpose. But what about in tax? They are not allowed. That is why they are added back to the profit. They are disallowables, in short, under tax. So in that scenario, you find that, yes, depreciation, for example, it was considered as a normal expense in accounting profit, but now it's not allowed for tax purpose. It's a disallowable. It's added back to the net profit when looking for the taxable profit to be used in the computation of the current tax. Then for the temporary difference is whereby you find items has been considered in both profit computations. That is both in accounting and in tax, but now in different time periods. So when I talk about different time periods, it means that based on the accounting concepts or accounting basis. So which are the accounting concepts you know? Which are some of the accounting concepts you know? So that is the accrual basis of accounting and cash basis of accounting. So when we talk about temporary difference, you find that yes, an item has been considered in both profit computation, that is in accounting and in tax, but now different time periods. For example, you find that incomes and expenses are recognized in accounting profit on accrual basis. In accrual basis. That is like now, when I say accrual basis, like expenses before you pay for them. If it's incomes, before you receive those incomes, you recognize them on accrual basis. You recognize them on accrual basis. But for tax basis, they are recognized on cash. On taxable profit, they are recognized on cash basis. So if it's expenses, you will only recognize once they are paid. If it's incomes, you recognize once you receive them. You receive them. maintain your background noise. That is, make sure your mic is muted. Just unmute everybody. So let's continue. So you have understood what is temporary difference and permanent difference. So, however, now International Accounting Standards 12 defines temporary difference as the difference between carrying amounts and the tax base. That is what I said. Even I went ahead to say what's carrying amount, what is tax base. So we have types of temporary difference. I talked about them, whereby we have taxable and deductible, whereby under taxable, carrying amount is less than tax base. What I can add under taxable is that it leads to deferred tax liability. For the deductible, it leads to deferred tax asset. It leads to the deferred tax asset. So we have types of income taxes, which I talked about them, current tax and the deferred tax. Current tax and the deferred tax. I said on how you are supposed to do the current tax, how you are supposed to do the current tax, whereby you take the taxable profit, you multiply the tax rate. How are you supposed to get the taxable profit? Accounting profit before tax, you add the disallowable expenses, you raise the allowable. You raise the allowable expenses. You raise the allowable expenses. So deferred taxes, I've talked about the two methods of computing that. So first, the definition of deferred tax. I say that these are the future tax obligations. They are either current tax payable in the future period or a provision for taxes for the next financial periods. For the next financial periods. So we have methods of which I said there is income statement liability method and balance sheet. So for the income statement liability method, we have three methods under that. But you can never be asked to use the income statement liability method. The balance sheet liability method is the one which is recommended. But again, you need to understand at least what is the income statement liability method. So under that, it has three methods: nil provision, full provision, and partial, of which the income statement liability method views deferred tax to arise from permanent differences. So when we talk about nil provision, it's only provisions which are made for the, when we talk about nil provision, under the approach, no provision is made for deferred tax. Provision is only made for current tax. When we talk about full provision, provision is made for both a deferred and current tax. So at least maybe on a scenario whereby you can be told to use the income statement liability method, you go and use the full provision under that income statement, because full provision at least makes provision for both deferred and current tax. So when we talk about partial provision is similar to full provision, with a clear evidence that there will be a refund of the tax in the future period. So I was still explaining this about the two methods. So I have talked about the income statement liability method, which has three methods: nil provision, full provision, and partial, of which I have said that income statement liability method views deferred tax to arise from permanent difference. And you need to know that permanent difference is the difference between the allowable expenses and disallowables. Then for the balance sheet now, which is highly recommended by the International Accounting Standards 12 to determine the deferred tax. So when you are supposed to get now the deferred tax, you use the balance sheet liability method, which views the deferred tax to arise from temporary difference. I already said that temporary difference is the difference between, you get it by taking the difference between the carrying amount and tax base, of which I said the carrying amount is all about the cost minus accumulated depreciation. What about the tax base? You take the cost, you minus the accumulated capital allowance. You minus the accumulated capital allowance. So I think I have simplified that. So we can do December 2012, question 2B. December 2012, question 2B. So let us check that question for December 2012, question 2. So they were saying that, this one, they were saying differentiate between taxable temporary difference and deductible. Who can differentiate for us this? How did I say you differentiate the two? Rose, how did we say we differentiate the two? I can see you have a lot of noise from your hand because your mic is unmuted. Yes, you can now answer the question I've asked. How do you differentiate the taxable temporary difference from deductible? I said the taxable temporary difference is whereby the carrying amount exceeds tax base, and it leads to deferred tax liability. That's all. Deductible temporary difference now is all about the vice versa of what you have said here, whereby you say is whereby the carrying amount is less than the tax base, and it leads to the deferred tax asset. I think if you were writing, you have written somewhere, but you have the notes. That is the best thing. So you can go and refer if you would forget before you sit your exams. They can ask, so you have seen they have asked here. They can even ask you, they can ask you differentiate between nil provision, partial provision, and full provision. You can be asked to differentiate those three methods under the income statement liability method. Or you can be told to justify why the balance sheet liability method is recommended, unlike the income statement liability method. So those are some of the theory you can expect. Or you can be told to explain about temporary difference or permanent difference. B, they say equip agencies limited purchased an equipment for 4 million on 1st July to 8. Depreciation on the equipment is provided on a straight line basis at the rate of 25% per annum. During the 4 years, from 1st July to 8 to 30th June 2012, the profit after tax and allowed wear and tear charges for tax purpose was as follows. So we have the period that is from 2009 to 2012. Profit after tax, you can see it's given. Allowable wear and tear charges. So the corporation tax rate is 30%. Required taxable profits, temporary differences, deferred tax account. Deferred tax account. Very good. And the best thing of CASNEM, you can find they can drift a question of this kind to a 2022 sitting. Like now they did RAS. I think there's no sitting I have ever did questions and they missed to bring even one in the exam. Like now RAS sitting, the question of partnership. In advanced financial reporting, the 3 questions of group, cash flow, and reconstruction. So that is why I always ask students that what we do in class, do you know how to do that before you start doing many things? What I have done here with you, are you sure of doing that? When I go to publish and do around 5 to 7 questions, can you be able to do all those 7 questions? When I go to group accounting, I do around 5 questions to 7 again. Are you capable to answer those questions correctly the way you have done in class? If you are capable of doing that, you don't even need extra questions to answer from the revision books, because you will find those revision books, others, they have a lot of mistakes. The way I've seen some of those books outside here. So if you can use those questions I do here, then maybe you ask some of the extra questions you will do on some other areas, you would be okay. So let us do this question: taxable profits, temporary difference, and a deferred tax account. This question is just when the examiner wants to give you free marks, because it's just not an hard question, but a simple one. Once you know how to do it, it's not challenging at all. It's all about getting these formulas I have written on the whiteboard and use them. So the first thing which was required for us to do is all about the taxable profit. So for us to do the taxable profit, you need to know that we start from the reported or accounting. It's all about reported profit. The reported profit before tax. You add the disallowable expenses. You raise the disallowable expenses. You add the disallowable, you raise the allowable. So we can do now, whereby the question was called equip agencies, taxable profit computation. Taxable profit computation. So that is for the year. So for the year ended, our financial year were ending when? So these years were ending on which period? So our financial year were ending on 30th June. So 30th June. So we have how many years? We have around 4 years, not around. We have 4 years. 2009, 2010, 2011, and 2012. So we have the 2009, 2010, 2012. So it was starting 2009, or it was starting 2008, 2009, I think. 2009, 2010, 20, up to 2012. So all the years were ending on 30th June. So we start from a reported profit before tax. So reported profit before tax. So the reported profit before tax. So the reported profit before tax, was it given in our question? So we have profit after tax. That is what you can see here. From your quantitative analysis method, now you can give me after tax. From your knowledge of mathematics, other than accounting, how can you get now the profit? Because you are given after tax. How can you get before tax? You just develop an equation whereby you can say here, you can say let profit before tax. Let profit before tax be X. Let the profit before tax be X. So if I take X, which is the whole number, minus the tax. Tax, remember, is 30%. 0.3X is equals to the profit after tax. So I will say X is equals to 0.3X minus, the first one was, the first for 2009, the profit after tax was 800,000. So how can I get profit after tax from that 800,000? So what I do, this one 0.7x is equals to 800,000. So I will divide by 0.7. I will divide with 0.7. So my x will be, so 800,000 divided by 0.7. That is 1142. I'm getting here, I can see 1142, 857, whole number. So I can say 1142, sorry, 1142, 857. So which means that for you to convert your profit after tax to profit before tax, in short, you divide that profit after tax with 0.7. You divide the profit after tax with the figure of the profit after tax with 0.7. So the second one was 900, 950, and 850. So 900 divided by 0.7. It will be 1285, 714. 1285, 714. Then the third one was 950, the profit after tax. So 1357, 143. Then the last one was the profit after tax. The profit after tax was 850. So 850. So it's 1214, 286. So after that, now you add the disallowable expenses. So for the disallowable expenses, we have here is depreciation. And remember, depreciation is based on the asset. You know, you can use straight line method to do depreciation, whereby it's based on cost. You multiply with the depreciation rate. What about reducing? Reducing method. So reducing method, you take the cost, you minus the accumulated depreciation. Then now you multiply with what? The depreciation rate. So on this scenario, you are told that the depreciation is based on what? Straight line method or what? So they said equipment is purchased an equipment for 4 million on 1st July 2028. Depreciation on equipment is provided on a straight line basis at the rate of 25%. At the rate of 25%. So on a straight line. So 4 million times 25%. 0.25 times 4 million. So that is a million. That is 1 million. That is 1 million. Then you rest the allowable expenses. So the allowable expenses are about the capital allowances. So to be specific in this question, we have the wear and the tear, WTA. The wear and the tear allowances. So the wear and the tear allowances is based on the percentages given. You multiply with the value of the asset. So the first one, allowable wear and tear. charges are 40%. 40% times 4 million. 40% of 4 million, that is 1.6. The second one is 30% of 4 million. Then 20 and 10. So the second one is all about 30. So this one will be 1.2. And the third one was 20. So that is 800,000. Then the last one is 1%. 1% or 10%. So that is 400,000. So for the allowables, we subtract. For the disallowables, we add back. So that up to that point, we can be able to get taxable profit. And let us do it. 1142. So once you have the taxable profit, remember that you can get your current tax, whereby you multiply this one, this answer with 30%. You can get your current tax. So why can't you even compute one for me? So this is the first one. I'm getting 542, 857 times 30%, so that I get the current tax direct. So this is 162, 857. And the second one, 2,285,714. 2,285,714. 2,285,714 minus 1.2. So this is 10,85, 714 times 30%. So this is 325, 714. And the third one, 2357, 143 minus 800,000. So this is 1557, 143 times 0.3. This is 467, 143. The last one was 2214, 286, 2214, 286 minus 400,000. So this is 1814, 286. Times 0.3. So 544, 544, 286, 286, 544, 286. So that is how the most thing they were in need of is the taxable profit. The first thing. It's only that I went ahead even to do the current tax, because once you have your taxable profit, then you multiply with the tax rate, you have your current tax. So the next requirement was, temporary difference Then from there, we do the deferred tax account. So the next thing we are supposed to do is temporary difference. So the temporary difference is all about the carrying amount you minus the tax base, of which you need to know that how do you get carrying amount? Cost minus accumulated depreciation. How do you get the tax base? Cost minus accumulated capital allowance. Cost minus the accumulated capital allowance. So again, I can say now equip. It was equip agencies. Temporary difference. For the year ended, 30th June 2009. So I will write here the first one is the year. Now I will put them in column format because I know if I take carrying amount, if I take the carrying amount, I minus the tax base. So we have the year, we have the carrying amount. I minus the tax base. I will be able to get the temporary difference. And if I take my temporary difference, I multiply with the tax rate. Temporary difference times tax rate. I would be able to get what? Deferred tax. And this one will assist us to do the account, the deferred tax account. So we have 2009, 2010, 2011, and 2012. 2009, 2010, 2011, and 2012. So you need to know that how do you get the carrying amount? Cost minus accumulated depreciation. So which means that the first year 2009, the cost of the asset was 4 million. Depreciation is a million. You remember how we got a million? 25%. So this one would be 3 million. So 2010, we take the 3 million minus the 1 million now of the next year. Because now it's accumulated depreciation. So we made with 2 million. The third year, that is 2011, it's now 2 million, this one, minus the 1 million, which is 1 million. Then 2012, the 1 million minus the 1 million, that is 0. This is how you get carrying amount. Tax base, 209, 4 million. The first year, the capital allowance was, capital allowance is 1.6. So 4 million minus 1.6, That is 2.4. 2010, it will be 2.4 minus the 1.2. So that is minus 1.2. This is 1.2. 2011, it will be 1.2 minus 0.8, the 800,000. We get 0.4. Remember, this is million. Then 2012 is equals to 0.4 minus the 0.4. This is the last one. So you get 0. Let's record. So this is 2,400,000. 1.2 we have 400,000 and a 0. So the difference, temporary difference, it's the difference between the carrying amount and tax base. So this minus this, 600. So this is a taxable temporary difference, because carrying amount is greater than tax base. So this one is 800,000. Taxable temporary difference again, because carrying amount is greater than tax base. The last one is 600,000. Taxable temporary difference, then 0. If you take your temporary difference, because obviously we know that deferred tax is equal to the temporary difference. We have the temporary difference. We multiply with the tax rate. We multiply with the tax rate. So tax rate was 0.3. So under the temporary differences, you have them now. These are the ones which are in this column. So the first one, 600,000 times 30%, which is 0.3, 180. So it means that this one will be 180,000, and this is 180,000. What about 800? It will be 240,000. And this is 0. You are done with the second requirement. We do the account. That's all. The topic will be over. The last part of the question is all about the deferred tax account. So you start from 209. The year was starting 209. So my balance brought down here. If there could have been balances from 208, so if it could have been a deferred tax asset, DTA, it could have appeared there. At the same time, we can have a balance brought down on this side. If it was a deferred tax liability, the deferred tax liability. So now we check a provision which was made in 209. So the provision which was made in 209 for deferred tax is this one we did here. That is why I did this last column. That is why I did this last column here. I want to display something here. So there's this column I did. So the first provision was this. So that is the provision they made for the deferred tax. So the 180. So I can see just a provision. Provision for deferred tax. Which is a deferred tax expense. So that is 180,000. So to make it balance, I will say balance carried down here, 180,000. So we have 180 there. And there we have 180,000. Then for 2010, I will just brought down this balance carried down here from 209 to the 180, so that I check the provision which was made here. So the provision which was made now in 2010 would be only 60, because they made provision of 180 in the previous year. So in the next year, there's this 240, but which is inclusive of 180, because you know that the previous provision which was made is to cater for the future obligations. So that is why I would say 240 minus 180, so that I will know in 2010 they made only a provision of 60, because this 180 is inclusive here. So this is 240,000. So the balance carried down will be the 240, so that I make the 2010 to balance. 2011, we have the balance brought down. This one, the balance carried down here of 240,000. Of which in 2011 there was a reduction from 240 to 160. So which means that there's a deferred tax income there. They never made a provision, but their obligation reduced. So which means that the difference of 60 I will debit here. A provision, but now which is an income, the 60. So that my balance carried down, to make this balance, the difference between the two will be 180. So that I get 240. And here we have the 240. Then we have 2012. The balance brought down, which is 180. Then the 180 reduced to 0. The reduction of 180 to 0. So that is why we say the provision, which is a deferred tax income of 180, because it reduced from 180 to 0. And now, if the examiner was in need of an income statement, you could have said, equip agencies income statement for the year ended 30th June. Remember, we have 2009, 2010, 2011, and 2012. So that we start from incomes. It's just an extract. This is just an extract. So incomes we have are the two, where the deferred tax reduced, where there was a reduction. The two. So we say deferred tax income, which is 60,000 and 180,000. Then you come talk about expenses. So you talk about the deferred tax expenses, which is this one, whereby it was increasing. where they made a provision, where we have an expense. So they have to make, this one, they made a provision for future taxes, because all of these were increasing. So the 180 and the 60. So for the last 2 years, dash. Then we were having a current tax, which is an expense. The current tax, we did it from our taxable, profit. So I can copy from my taxable profit this current tax. So we have 162, 857. We have 325, 714. We have 467, 143. And the last one was 544, 286. 286. And that is how you can do the income statement extract if the examiner was in need of one. And that marks the end of this question.